Hey everybody, Tom Gentile. Welcome to another edition of LiveTrade. It's Tuesday, February the 5th, 2020. Glad to have you guys all in here. Another crazy day in the markets. We'll get to it here in just a moment. Just want to double check and make sure both that I can be heard and seen. So guys, just give me a quick shout in the Q&A box. Let me know you can see the screen and that you can hear me. I should be coming in loud and clear.
Good
Awesome.
feedback there, yep.
That is good. We were a little bit concerned. That's why we jumped in a little bit late here. But anyway, glad to see everything's working just fine. All right, so we got a fantastic program for you today. We're going to slow it down a little bit. We're going to talk a little more in terms of calls, puts, and spreads today. In fact, we're going to get more detailed in calls and puts. And I want to back up and show you guys, well, this is really for a lot of you that were here last week, but it's for everybody because we're going to do a back test on a strategy that we talked about last Wednesday, right at the close. And so we'll look and see how that strategy actually turned out. If you got questions, comments, you can put them up live on the board, and we'll ask and answer the most popular ones that are there. Also, the recording will go out as soon as I possibly can get it out to you guys. Because these webinars are so long, it takes a while to spool them once they're done and spool them up to our channel to be able to get them out to you. But we'll get it out as soon as possible. And then finally, the disclaimer you see on the screen. Again, you can read this in its entirety from the recording. I'm just going to mention two things real quick. Number one, stock and options trading has large potential rewards, but also large potential risk. The other thing I want to mention is that myself, Jay, and anyone else associated with Optionetics or Tom's Trading Room, we're here as educators. We're here to show you how it is that we trade, all right? And we're not investment advisors. We're not brokers. We don't give specific individualized trading advice. And everything I will be talking about today is in US dollars unless noted otherwise. All right, so first of all, welcome back to our Optionetics students. We've opened this live trade session. We did this an entire month of February, and I decided to do it for a couple weeks in March and bring everybody in so you can see how it is we're trading. We're going to mix a little more education. Today, yesterday I got a little bit crazy like I did the entire month of February and just, found opportunities, trade them, found opportunities, trade them. I'm going to slow it down a little bit. I do have some things that I want to show you that I'm looking at, that I'm trading into right now. I'm trying to get into that OIH spread that I did yesterday. Nothing's filled yet. I also like the bond market short. I'll get to that. And then we've got lots of other things to cover here over the next hour or two. Anyway, welcome back, students. We are integrating the Optionetics Trading Essentials classes this month with live trading. That means options like calls, puts, debit spreads, credit spreads. We'll be evaluating them and using them with our strategies. And what we'll be doing is today I'm going to educate calls and puts, and I'm going to show you what we did with calls and puts last week. We are going to evaluate spreads today, but I'll get into the details of spreads and educational detail spreads tomorrow. Everything that we're doing involves our software, tomsoptiontools.com. We're also using the Thinkorswim platform as well. But I'm going to not do so much with Thinkorswim today. I'm going to do a lot more with it tomorrow. I might just show you the charting methods of it today, but we're going to get into it in more detail tomorrow. But anyway, our Tom's Option Tools programs, because we got several of them out there, they start at $79 a month. If you want to subscribe, this is what you will do. You simply will go to tomsoptiontools.com, right? www.tomsoptiontools.com. If you already have an account, username and password, but if you don't, or you used to and you want to re-up and start doing this again, subscriptions tab just above the username, go to subscribe if you've never subscribed before, go to renew if you have subscribed before and you let your account lapse, and that will give you the walkthrough on how to subscribe and become a tools member. All right, we have 4 different areas for our tools members to go. We have what's called our option trader column, contrarian trader, complete trader, and the complete trader actually gets to is a package which includes option and contrarian. So they step up. Now over here on the far right hand side is our partners and masters, where we have proprietary scans that go with different classes that are offered once a year, only once a year. These classes are offered by not only myself, but folks like Mike Wade, Joe Contes, Jeff Beamer, etc. We've got several folks that have their own style of trading, and they have their own buttons, their own scan buttons, and those scan buttons are included as part of their trading. And that's what's over here in the Partners and Masters section. All right, we will be working within these three: option trader, contrarian trader, complete trader. All right, over the next 2 weeks. Okay, so again, subscribe. You just got to hit the subscribe button and follow the bouncing ball. All right, so let's get back to what we're going to cover today. I want to talk about a market update again. Now that we've cut rates by 50 basis points, we'll look at any options volatility. We'll look at Darknet signals. We'll look at money patterns today. I'll be placing orders. All right, I'm going to be using Street Smart Edge as the order that I placed my trades on. And then we'll be doing questions, comments, etc. We'll finish up with our option X mantra as we close out the session. But before we do any of this, let's talk about two areas that need bear repeating. And the first area is, where are the best tradable stocks at, Tom? I get this question all the time. And so I look for market liquidity, I look for stock mobility, and I look for short-term optionable. And so what we do is we focus on those three areas to give us ideas of where we want to trade. So market liquidity, if you were to go to cboe.org, or you could Google penny pilot list. All right, let me just show you how that works. So we want to find the greatest liquidity out there, especially in environments like this, where now we're down just a little less than, we're down almost 500 points as of right now. All right, it seems like the new norm since the coronavirus came to town is up 1,200, down 500, up 1,000, down 1,000. I mean, just crazy. So you want liquidity. And the reason you want liquidity is so your spreads aren't that wide, and you want to go where the spreads are thin, right? So we're looking for something called a penny pilot list. And so to get there, let me show you how that works. I'm going to go and I'm going to go to Google, and I'm going to type in penny pilot program. And at the very top of penny pilot program, you'll see miaxoptions.com. If you go to click on miaxoptions.com at MIAX, this is the penny pilot program. You don't have to go anywhere in this front page, because right here is a .csv file of the MIAX Emerald Penny Pilot class. If you click on that, it's going to download the updated penny pilot program, and you can open that if you have Excel, or you have in this case we're looking at is this Numbers or Pages? It's one of the Apple ones, but it's going to give me that list of all the stocks that are liquid. All right, that means their options trade inside the 5-cent bid-ask window. Doesn't mean they always, I mean, they're going to be wide, but they can get as thin as pennies between the bid and the ask. And you can save that. That's actually already there, saved in my file. If you're a Tom's Option Tools member, this is already loaded up as part of our options, because, for instance, if I were to go to Tom's Option Tools, let me do that real quick. I want to show you where that is. So I'm going to log in up here where we've got lists. All right, so go to website and go to lists, and then I have lists, and you can create your own lists. But here, an example, I have a penny and weekly list. All right, and that pennies and weekly list is all the stocks. There's 250 of them that are both stocks and ETFs that are both penny pilot that trade weekly options. So I'm looking at a list of 250. What are you looking at? And that's the question you need to ask yourself. All right, so that's where I start. Okay, now that we've looked at some pennies and weeklies, let's talk about, and you know, the Google Penny Pilot program, why we trade options. We trade options for control. That's leverage. We trade options for protection. All right, and we trade options to pay for protection. Hey Jay, does Washington State have do they have vanity plates where you can get a license plate and put whatever you want on it, barring that it's a certain number of letters or less? All right, I'll take that as a no. So in the state of Florida, we have the ability to have vanity plates. And I actually was looking for one, and leverage is actually available as a vanity plate in the state of Florida. And so, you know, those of you in Florida, you might want to go and grab that if you like that name. That's what I do on the weekends, guys. If you don't know what I do on the weekends, I surf weekend Wall Street to see where the market's going to open on Sunday night and Monday morning, and I do that kind of stuff. All right. So any of you have that ability to find in the to find vanity plates? Curious if you do or not. So Tiffany's asking, do we physically update the penny palette in Tom's tools, or is it done automatically? On a regular basis, Tiffany, it is updated in the tools. So there's nothing you need to do. All right. All right. So types of options. So we have calls out there that we can look at. We have puts. I'm going to spend a little bit of time talking about calls and puts. And from here, we can, you know, this is the first step in understanding what options are. I'm not going to spend a lot of time on this because all of you in the room should know what a call is. It's the right to buy. A put gives you the right to sell. I'm going to be looking at both a bullish and I've got a bullish and bearish opportunity I'm trying to get into right now. And I will be getting to those. All right. I think maybe I'm too stingy because I haven't heard the ding yet that I've been filled on anything. So we got time. But let's just talk mostly about calls real quick and options themselves, and then we'll get into. I want to show you a strategy we did last week, and we'll take it from beginning to end. All right. Then we'll look at some puts. Contract size. So I have 1 equals 100. That basically means that one contract is good for 100 shares of stock in the US and in most other countries. In a few countries, one actually equals 1,000. Right? So keep that in mind as we're looking at this. All right. Strike price. That's another thing you need to know about options, and that's the price agreed upon between the buyer and seller, the price the buyer can exercise the option for. All right. Now, a more important question that I'd like to ask you. All right. I'd like to ask you this question. So how many of you have exercised an option or been assigned an option? Who in the room has been exercised or assigned on an option? John, I should imagine you. Because I think I might have asked this question before. It's not the scariest thing in the world, by the way, guys. I get exercised on options quite a bit. In fact, I got exercised on some OIH and I got exercised on some TLT over the weekend. And so that's typically what ends up happening is I take something through Friday, you know, and the reason I'll tell you the reason I do it. The reason I do it is because either A, I want the stock, all right, or B, I'd rather take the stock and get rid of it than some of the awful spreads that have happened here recently. All right, it actually ends up being, for me, a better situation. And I think for a lot of you, it's a better situation as well. Wow, look at all these people assigned. I mean, a lot of you I see have been assigned. And Pat, I'm not going to repeat what you said, but I agree. I'll say it in a little bit more PG terms. And pooped my pants the first time. Yes, yeah, because you know we're all a little nervous about you know exercise and assignment. But here Robert even says made some dope money on them, and you know what, you can do that too. So you know it's you know that happens. All right, so let's kind of move on here. So a couple more things. Expiration dates important. You know, we have expiration dates that fall on the third Friday. We have weeklies. We have Monday and Wednesday options and Fridays. We have EOMs. We have quarterlies. We have leaves. What's your best? Well, it depends on you as a trader. Okay, you as a trader, you know, of all of these, what do I like best? I like the third Friday of each month. They're the most liquid out of everything. All right, but I'm also a short-term trader, so I like the short-term stuff. And I'm a long-term trader. I like leaps too. All right, I'll tell you what I don't like. How about that? Let's go there. So I'm starting to like these Monday and Wednesday options on SPY and some of the ETFs. But the ones that I hate, the ones that I avoid, are the EOM. Okay, those are the end of month options. They expire on the last trading day of the month. And I'm not a fan of quarterlies either. All right. And the reason why is because those have the least amount of liquidity in them. That's where a lot of people are not crazy about EOMs. And if you see EOM options anywhere, there's also these options called flex options. I'd avoid those at all costs because, again, it's just not something that it's just not something that I'm a big fan of. All right. So other definitions: in the money, out of the money, at the money. These are just basically where the option is relative to the stock price. In the monies have real value. Out of the monies have no real value. At the monies don't have any real value either. They're just very close to having some real value, or not. Okay, so that's something to just to pass along too. Volatility, big one that we're dealing with right now. So volatility in the marketplace, it's in the market right now. It's the speed of the stock relative to time. Two types of volatility we use. Number one is statistical. That's actually if you use Bollinger Bands. All right. How many of you in here use either average true range or use Bollinger Bands? Those are two indicators that rely on statistical volatility. All right. That's also called stock volatility. ATR, as James says it. All right, ATR. That's kind of important that you know that one. And then and BB, Bollinger Bands, absolutely. Those use statistical volatility. Implied volatility, you've got to you've got to know again or have some access to being able to find that. So I want to show you both of those on the tools real quick. So in order to get to statistical volatility, what we can do is we can go to stocks and charts, and we can go to stock charts. And I'm actually going to start with just SPY. So I'm typing in SPY. Here's a chart of the S&P 500 right now. As you can see, a lot of movement in the last 2 weeks. So what can we look at here? I can look at stock charts. I can look at implied IVs. I can look at SVs. Okay, so if I were to look at the statistical volatility, I got filled on something. The statistical volatility on SPY, I would just click update, and now I'm going to see some lines. Notice the statistical volatility has gone from a couple weeks ago, it was down here around below 11, and now it's above 44. So it's good to say a statistical volatility is greater than 3 times where it was just a couple weeks ago. Now, if I were to look at, for instance, the stock chart, and then underneath that stock chart, I could look at the 6-day SV, I'm going to see a chart of stocks and a chart of statistical volatility. Look at the statistical volatility. This thing was down here, it was like close to a 5. Now it's at 50. So it's good to say that the statistical volatility is now 10 times what it was just 2 weeks ago. Implied volatility is more of where option traders think the volatility is going in the future. Let's update that. All right. I'm also going to spread the chart out a bit. So let's make this a 30-day chart instead of 120. Now you get a better read on it. Let's blow this up. Now we can see this. Implied volatility at the bottom. Nobody cares about anything. Look, it starts popping up as we're in this area. Then we get the drop down, and it's up here. Now we're dropping down and moving higher and lower. And now we're no longer at now 10 or 15 or 20. Now we hit 45, we pop down, and it looks like we're on the climb again today because, again, the markets are dropping. All right, we're down 600 points right now in the market. So you can bet implied volatility is moving a little higher. Okay, so that's what I see right now in terms of how to chart. Again, and this is option prices, guys. This is giving us an idea where option prices are going. So that is that is two types of volatility. All right. Now, last week we discussed something called the L2F4 strategy. I want to use the L2F4 strategy. I want to talk about call options. So let me remind those of you that were with us last week, and of course, let me show those of you that are with us this week what the L2F4 strategy is. It's a long-term pattern. It spots institutional money flowing into the markets the first week of each month. The pattern's been around for decades. The way to play it is to get ahead of the institutional money and look at buying ETFs like SPY and QQQ on the opening of the second to the last trading day of the month and exiting the trade near the close of the fourth trading day of the month. Right? These are trading days, not calendar days, so they change depending on when these trading days fall. Now, this was the last two first four for February and March. You can see the last 2 days actually started on the 27th, and the first four end over here on the 5th, which is in 2 days. Now, what I like to do is I like to buy options on SPY or QQQ, and I like to have a target price on those ETFs. And my target is 50%. All right, so you buy slightly in the money calls. You can do it as a limit or even a market order due to the efficiency of ETFs, because now ETFs are a little bit more inefficient today than they were 2 weeks ago. It's a 6-day trading strategy, all right, and it looks like this. For instance, if it were last week and it were last Thursday, I would be looking at the March 6th options, slightly in the money calls, and I would have some sort of a limit price on it as a day-only order. All right, I look for a 50% gain as an exit. Otherwise, you exit the final hour of the last day of the 6-day strategy. Let's see how this is done for this particular month. So to do that, we're going to go into backtest mode. That's something else which is really cool that we can do here with Tom's option tools. Is I'm going to go back to February, and I'm going to go to the 27th. Now, here's the 27th. You remember this day. Let's go to the option chains, and we're looking at March 6th options. All right, so March 6th options look like this. Where's the at the money call? Or slightly in the money. So if the market's at 297.70, look at those March 6th calls. They're not cheap. They're $8.02. Now I want to throw this up here just to kind of show you what's going on. So this is the even if we were to look at maybe the 295s, those are slightly in the money. All right, so let's take those. For 20 cents more, I get 50 cents deeper in the money. So let's just buy that one. So we're buying the March 6th 297 calls. Remember, we have a week to expiration. There they are. Place it as a limit order. And then how you're able to track this is you simply look at where we are and you go forward a day. So let's go to Monday, or no, this will be Friday. So we'll go to Friday. Okay, up $59, up 7%. Let's go to Monday. Boom, up 50 to 52%. So what happened on Monday, ladies and gentlemen? We hit our 50% target. Sold, and you're out. That's simple. And good thing too, because you go plus a day, and now we're only up 24%. That's as of right now. All right, but still up. All right, so we've done a lot of the math on this, and we find that 50% return is a really good target. All right, because it's often hit. And then from there, yeah, sometimes we'll lose the chance of getting a double. But with ETFs, remember, an ETF is a basket of stocks or a basket of assets, and a lot of those assets are fighting each other sometimes too. So it's good to be realistic when it comes to a stock or an index like SPY. All right, so there was the trade last week. We were looking at it last week. We were looking at this a day ahead of time, saying this is what we were looking at doing. And of course, you can see what happened here with this particular one. And this was Thursday. All right, Thursday, Friday, Monday, Tuesday. Worst case would be Wednesday, Thursday, and then you're out by Thursday. So, so there is an example of a call option. All right, or not? A call option on a strategy. Remember the mantra, and I'm going to say it again. You spot that opportunity. The opportunity in this case was the last two first four. You create the low risk trade. Now, could we have done a spread on this? Possibly. Let's go ahead and take a look. Let's back up a second and let's look at how we would spread this option for $500 or less. So if you're going to buy the $8.29 option, I'd need to sell something for $3.29 or more. Well, gosh, we can go over here and buy the 306s, but let's just do the 305s. So -1. So I'm buying the 297s and I'm selling the 305s. All right, let's look at that risk graph. Now, instead of paying 829 by spreading, I'm paying 420, almost half. Let's see where this went in those 2 days. Here's Friday, it's down. How can that be down? Well, because if you look here, you got an option. The 297 call went up a little bit, but the 305 went up a lot more. So that's why you're down $4. Let's see what happened on Monday. Up 36%. Okay, so this particular option went up only 36%. And the reason why it did was because it had something fighting against it. Now, let's just look one more time. Let's look at what happened today. Up 22%. So what's happened is this option didn't fall off as much. This spread didn't fall off as much as the overall option because we did see a little bit of a drop. But guess what happened? The options that we sold dropped off almost as fast as the options we bought. So spreads you can do for less cost, less risk. They do have a little bit less fluctuation, as you can see here on this particular trade. All right, but I really wanted to show you the call option and taking the call and utilizing it on the L2F4 strategy. All right, with puts have the same characteristics as long calls, but in down markets. So they have that same 1 to 100 contract size that as calls. They get the same number of strike prices and expiration dates as calls, but they increase in value as put prices decrease. All right, so let's do a little update, a little quick market update, and we'll kind of see where things are as the markets continue to drop. I think we're down 665 now on the screen that I'm seeing outside of my webinar and podcasting room. Here we go, guys. Here's coronavirus. Here is the world map. Basically, we've got the hot spots are China, Iran, and Italy, with cases pretty much all over the country, with the exception of a few spots. I might also mention that that most of the deaths are in China still. All right, and again, we're seeing that that a lot of the deaths are happening on certain scopes of people. People that have pre-existing conditions seem to fall into that category as well. All right, but again, how does this relate to the market, number one, and how do we exploit it in terms of traders? Well, that's where I go into Option Trader. And Option Trader allows me to look at charts and backtest option strategies to see how things would work out in this environment. So when I looked at the charts, and I already put them together for us prior to coming on, SPY opened early this morning, jumped above. Last week closed above its channels. And of course, yesterday we had that big 1,200 point day up, so that was great too. That was a big move up in the market. I still think we got risk in the equities, all right? And of course, I was going to say that regardless of where we are right now, but it seems like the markets want to move down today now that they've bought the rumor and they've sold the news on the Fed. TLT popped on the rate cut, but the move seems to be overdone. And you know what I'm going to do? I'm actually going to look. Let's slide over and let's look at some real-time charts. Okay, here's real-time. And so we've got now the markets are moving lower. TLT is moving higher, but I would see any close above 156.50 as the fact that the move isn't done yet in the market in TLT. We've got Gold over here I'm keeping an eye on, which has come up nicely. This shows GLD up $5.51. That's roughly $55 an ounce on gold. So gold has actually come back quite a bit. You take a look at this chart here. You know, this was the highs last week. As we were up, actually the highs last week were up in the 160s. In fact, if we were to look at a 15-minute bar, that really will give us, yeah, there's last week. Need a little bit more than that. Let's pull the daily up. There we go, 158.53. And look at where we are now. We come all the way down to the 140s, and we're right back to 154.66. So possibly on its way back up. Yeah, it's volatility is here to stay. That's for sure. So TLT, I think, might be overdone. We'll see if buy the rumor, sell the news is indeed the same with TLT. The dollar did get it did come off a bit this morning, but seems to still be trying to find support down here in the low 26s. That is UUP. All right, and I'm looking at channels, and I'm looking at the long-term channels and intermediate, which are down here in the high 26s. Or I'm sorry, high 25s, and we're actually in that low 26 area right now, where it's trying to find support. And USO again, the support level in USO is 9.5. Let me show you how you do this. All right, I'm going to show you OIH. So how do you get a chart like this on Tom's Option Tools? Which this is a chart that we use to help with Darknet strategies. To do that, you will go to the tools. All right, you can do this with the Option Trader account, which is the least expensive subscription we have. You'll go to stock charts. All right, go to charts, stock charts, bring up the stock charts, and what you'll do is you'll bring up, let's bring up OIH. All right, this is one that I'm tracking. Let's click update on it. Now this is OIH itself, but let's take a look at OIH with a channel test. Does everybody see that button, channel test? Click on that. That's going to set us back. And what it's showing me is the long-term and the short-term channels are all converging down around this point right here. Now, I want to show you one more chart type, and this is the Darknet chart type. All right, we like to call it Alpha 9 Darknet. And just a day ago, we had another signal, a buy signal that occurred yesterday. So even our Darknet channels are telling us that this area is converging right here in terms of price. All right. So that is a quick look at charts. And if one more, well, we looked at gold, but gold looks like it's back on the rise again. I pretty much mentioned that. And so what I'm going to do now is let's look at some trading opportunities if we can. And so to do that, Jay Harris, are you with us still?
I'm still hovering, yes, sir.
There you are. Okay, so how about I turn this over to you for some Darknet and money patterns?
Let's get into it.
Awesome. All right, so I am going to make you the presenter. You now have the controls.
And I'm showing my screen, and we should be on the Darknet page.
Awesome. And if you don't mind, I might break in and just let the guys know what I'm doing. I have a couple of things, so I'm going to jump over to my orders and just kind of see what's going on over there.
If you don't jump in, they're going to make me stop when they hear those dings. They gots to know.
Yep. Oh, so I did a couple credit spreads, and I'll let you guys know the 97, those 97 OIHs that I tried to get filled yesterday at 23 cents. Well, they got filled today at 23 cents. So I'm in that vertical put spread. I'll show you the details of that trade when I grab that back. I also went in and did a vertical call spread on TLT because I'm looking at OIH is the signal that based on what you're going to be showing, and that was yesterday, but I'm taking it today. And then there's a TLT, which I'm utilizing simply because it's the most liquid on the bearish side that I can find. And so I've got a trade on that I'm going to show too. So all yours, Jay.
Thank you. All right, I appreciate it. Hello, everyone. I am muting my Skype. I have Skype open on the other laptop here, Tom, so we won't be interrupted on our live session here and all. And I've muted it so we don't hear the ringing if anybody calls in as well. Folks, good afternoon. We are at a 50% give back thus far on the Dow from yesterday's historic gain. And we'll see if, well, like Tom said, it looks like everybody is selling the news. The fact that the Fed did do the cut, they're selling that news, whether that conviction to the downside maintains the rest of the day or not is to be determined. It would be nice to see some follow through from that historic up day yesterday. And in fact, that upswing started on Friday, about the last hour of the close. And so if we can continue to maintain this price level or higher, that's optimistic for a little bit more of this retracement, dump, correction, whatever you want to call it, from the highs. I mean, if we can just, keep eating our way into more of that downward slide, some more of our long-term equities values will be recovered. Nonetheless, let's focus on some of the shorter term stuff. Let's start out with the Darknet. We always go to Home, Tom's Tools, and when we're on that page or any other page, we can always go to Home, Tom's Tools, and go back to Ground Zero, go back to Home Base, where we have the 4 different tabs here and all: Option Trader, Contrarian Trader, Complete Trader. You can click on the Options Analysis Darknet Channels icon, and you'll go to the page that we want to get to for Darknet, or you can go to Home and then Darknet Signals. We like to leave it on all Darknet stocks. We like to leave it on trade type displayed. Actually, we need to change that to call option trades, so that if we do look at the chart and we do like the opportunity for an option trade on that, we then have the lowest percent to double option on that. As you see down below, here is our table for right now with a delay of about 15 minutes, which the tools do. Now, I also have on the test site the candles, because I like to go to those and I like to kind of like whittle this list down from, more than 5 to 10 to about 5 to 10, where the Darknet plus the candles are coming in. But let's just say we don't have that yet, because we don't have it just yet. So let's use this right now. And real quick, the quick down and dirty way that I want to show you how to kind of like go through this list is as follows. Look at your slippage. Now, obviously, these are ranked by percent to double, lowest to the highest. And so we're going to continue to leave that the case. We're going to keep this thing here going with the percent to double, lowest to highest first. Hi, John. And we're going to now focus on the slippage. If the slippage is greater than 1, we're just going to skip on past that. So even though leg Mason is there and the option is less than $5, that's one of the other filters that we want to kind of mentally and visually do here. We want a slippage under 1 and a call option that's less than $5 for the contract. And it comes down to that risk money management. The theoretical account of 25,000 risking no more than 2% or $500 per trade. So one contract is 100 shares. A $5 cost is $500 for the contract. So slippage less than 1, option contract less than 5. Less than 5, yes. Slippage too wide. Okay. Sirius, Pepsi, Sempra, all of these you're going to see as we go are going to exclude themselves from consideration because the slippage is too high. Or here's PepsiCo, the slippage is 0.4, that's less than 1% slippage, that's great, but the cost, 568, okay? The other thing we're going to eliminate is any of these iShares, Vanguards, Ultra Pro shorts for the most part. If it's not the major 3 ETFs for the Dow, NASDAQ, S&P, like the SPY, DIA, we're going to disregard those. We'll look at TOT or TBT because that's one of Tom's 4 corners of the market if they show up. And then any of the sector spiders, the S&P 500 ETFs, and you can go to sectorspider.com, look at the 11 sectors there, XLY, XLF, XLI, and so on. So what I do is I scroll on down. Now, before we started speaking today, BMY was up. There's BMY, Bristol Myers Squibb. It's a Darknet B bullish. We have a low percent to double of 7.92. Slippage coming in under 1. And the option contract price is less than 5. So that was the one I was going to look at. Now, you can see up here that going through that list and that filtering process, we could even start with LAMR, okay? The cost for the contract at the time of our recording, and the refresh of this list was 410. So that technically qualifies, and 0.9 technically qualifies. So let's take a look at the chart, shall we? LAMR, what do we see that we like? Do we have the Darknet B bullish signal? Yeah, it wouldn't be on the list otherwise. Is it testing a support area? And you can bring channel supports up and other things, but right now it's testing a 200-day simple moving average. And is it testing a price support area? Yeah, right around 83 or so. So those two things are going for it. Now, you may not like today's price action, the fact that this had this long upper shadow from a candlestick perspective. It means it traded much higher on the day, and we're closing back into where it opened on the day. But that's one consideration. So there's LAMR as a consideration. Okay, I'm going to scroll down, and let's click on the BMY that I had prepared to show everybody prior to this list being refreshed. So when you click on BMY, if you don't see any charts or anything change, it's because it's up here on your screen. Go back up and you'll see that that chart that you brought up now changes to the BMY, or the Bristol-Myers Squibb chart. Do we have a moving average support? No. Do we have a previous price support? This previous price resistance, this previous pivot high that it broke out from, is now retraced back to about that price area. A little bit lower on that day, rallied back up, and is now 2 days higher past that test of that previous resistance. Today's action is trading near the lows. So the question now becomes, between these two, which do you favor? Okay, you can go ahead and paper trade both. Do you guys, if you want to type in a preference, we'll go to the one that you guys say you want to look at. Because right now we have just looked at the chart, the Darknet B bullish signal, and seen how it looks in its overall chart. If there's any previous, trend support, moving average support that we can pay attention to. And let me scroll on down the board here and see what's coming in. BMY is the overwhelming favorite. Okay, so now we don't need to go to an option chain on this, because when we bring up the call option trades for Darknet, it's going to have that column for call trade, which is the option trade on that string of options for that security that has the lowest percent to double. So where are we back here? BMY, right there. Scroll on over, left click on that green underlined hyperlink for BMY, okay? So here is our risk graph page. Now we have an entry debit of 310. Is that less than the 5? Yes, it is, okay? How's our slippage looking? It looks good because it came from that previous board that said it was a low slippage, like a 0.3, I believe. There's not much more you need to do here, folks. You can go down and take a look and say, well, let me just, for shiggles and gigs, look at what that price is to double. It said 7.9% to double. What does that equate to? 64.20, meaning in the worst case scenario, if you have to hold on to this until expiration, it needs to at least be at 64.20 for that option premium to double. These different 1/4 of the way to expiration intervals, red is from now until expiration, blue is 1/4 of the way through, green 3/4, and then at expiration there, okay? So there's the different price intervals at different time intervals of where the stock needs to be to see a double. Now, let's scroll back up. What does it need to be again? 64.20, all right? 64.20, is that doable? That's right up in here, right? 64.20. If we get this V bottom and a recovery and it spikes up to 64, we've got the opportunity, the potential for a double. And if you get half of that and you don't make 100%, maybe you come in around 40, 50%, are you still going to be happy on this? If everything looks like a go, let's go ahead and just save this trade. Alan's asking how I deduced the list yesterday. I did it with the candlesticks, and I'll show you that again. This is to come. Okay, we're not quite there yet. We hope to be there soon, Alan. Okay, I'll get to that in just a moment, though. So there you go, folks. We have Bristol-Myers Squibb, the March 27th, $58 call, and the tools are showing you, again, it's about a 15-minute delay. Go ahead and look at your real time, but the spread looks pretty good. It's working the mid price of the bid-ask quote there for you. Find your folder, and again, there's a video in the library that shows you how to create a folder. And so once you have that folder created, Darknet Bullish, click on that folder, left click on save, and we now have that one in our saved folder for the Darknet bullish opportunities, okay? And we can go to trades, saved trades, click on saved trades, find that folder. There's a Darknet bullish folder, and there's the trade right there, BMY, to confirm that it has been saved in that folder. What did we do yesterday? I think we looked at a trade on, let's go save trades. Well, we're already here. Let's find the folder we did yesterday. I think we did a Darknet with Morningstar reversal. Is that correct, folks? Okay, that was a paper trade. That folder is up. There's the trade. It was on a Merck long call option. Click check all, because if there's more than one, you can click check all, and it should put the check mark in the check trades for profit and loss column over here. And it does it on all of those. If you just want to go one by one, then don't check all, just check the one you want, click profit and loss. And here's a snapshot right now that Merck is down about 18% on this option trade. You want to click on backtest and see what it's done over the course of the trade. There's your profit and loss at the end of each day for those. Okay. Let's go back. Trades, saved trades. Go back here to Merck and click on profit and loss. You can click on the trade name there. You can do a fast chart for the stock symbol. Okay. So yesterday is where we were initiating the long call. This is the price action thus far today. It's maintaining the upper range of its trading range from yesterday, but it is down on the day, hence the down or paper loss showing thus far on the option trade. It's at about 18% currently, okay? So that's a long call option trade based off the education Tom wanted to provide you on long calls. I did one other thing here. Let's get out of that and out of that. And here we're going to go with the test page for the bullish candle reversal patterns, just to take advantage of the fact that Tom and I can get here, show you opportunities. And on this one here, you see how we whittled the list. So when this becomes available to you guys, and I just saw some back and forth between Kevin and Jim again today about what the backtester's picking up, what it left out, and so Jim's on it for another quick fix, and hopefully we're getting closer. But the first one on the list here is Eli Lilly, and we like that, except for what? We have a $6.60 cost per contract. So if we're going to stay disciplined and do a less than $5 cost for our trades, we would pass this by. But if a long call is too expensive, how do we minimize the cost of a long call? We hedge it and we create a spread. So we can go up here to the spreads and click on that button for spreads. And instead of doing it on a list, do it on that ticker symbol. So we like Lilly. A straight option was too expensive. We can type in Lilly for the spread, leave all the selections here for the criteria as they are, and then left click on search and see if it finds a spread opportunity. And here it is. So let's take a look at this, and maybe this becomes a saved opportunity for you. It is a 131.125 put credit spread. Okay, so if we want to look at the more details on the risk graph, click the hyperlink and it goes to your risk graph page, and here we are for Lilly. What's the cost? 187. What's the potential max ROI? 45%. Remember, in this high volatility market where prices are getting jacked up and spreads of these bid and asks for options are just widening out beyond all belief, 100%ers may not be as reasonable as they are in a more calm market. So 45%er, okay, where do we need the stock to be? Above 131. Remember, you're selling the market's the right to put you to stock at 131. In a put credit spread situation, we want these to expire. So where do we want the stock? Above 131. Because why would anybody in the universe put you to stock at a lower price that they can get on the open market? They're going to take that higher price, which means that sold put at 131 is going to expire, which means you never have to exercise your right to buy the put, and you're going to keep that credit. And you keep that credit at a 45% return so long as when options expiration hits for this, which is the close of market on March 20th, if it's above 131, that money is freed up from escrow, freed up from the margin hold requirements in the account, and you've got that to go buy Christmas presents. So here we are. Do you like that opportunity above 131, right? It's above 131 right now. So we're not asking it to do much, but just pretty much stay right where it's at, right? We have a Darknet R reiterated bullish signal, a Morningstar reversal of those three candles, and it's maintaining thus far. And if you like the idea of it maintaining above 131 or going even a little bit higher over 131 and a 45%er in this market seems like a nice victory, guess what you do? Go back to your saved folder, Darknet bullish, and in fact, we can go Darknet Morningstar reversal. But if you don't have the Morningstar reversal in there because you don't have the capability to look at the candlestick scans just yet, go ahead with your Darknet bullish folder, click save, and there you go. Okay, so let's look at the Q&A boards. Tom, do you see anything right there as I go through and look at?
Let me look.
Carl's wanting to point out that that cost, 187, is not a cost. That's a credit. So what is your cost? Your max risk on a $5 spread with 187 credit is how much? The max risk is right there. Is 413 still less than the 500? Yeah, so that's fine there, okay? And thanks for the note on the recovery there, Carl. Okay, so there we are, guys.
Yeah, and Liz is asking how you got to show the Greeks from the saved trades.
From the saved trades.
Yeah, she says, how did you get to show the Greeks from saved trades?
Well, let's go back to saved trades and see if I'm tracking what she's actually asking there, okay? So trades, saved trades. I got my window in my way, Tom. Sorry about that. Trades, saved trades, saved trades. That came up when we were bringing up the risk graph on that, correct? So let's go to Darknet Morningstar reversal. Let's go to Merck and hit profit and loss. And when you do the fast chart stock symbol, is that the one?
Scroll down. I don't see it, but
on the back test. On the back test, there's all the Greeks over here.
Right, and
that's a daily accounting of the Greek for that day for the change.
That might be what she's looking for.
Okay, right there. It's when you look at your profit loss and you click on your backtest button and you get to this page, Liz, backtest with Greeks. That's how you get the Greeks. Okay. All right. Thank you. Anything else, Tom, or should we move into money calendar?
No, let's move into money calendar.
Money calendar it is, folks. Here we are. We preferred you, and I've answered this question numerous times on the support emails. We prefer you do this at the end of market. Reason being, if you look, and we'll click on today, March 3rd, because that's what day we're on, but we typically like you to do it tonight when the market's closed, looking at March 4's information. If you see a stock or a security here, like a C-Trip that says it's got an average profit move of $3.10, and you see that this is a bullish candidate with a $3.10 average profit move, but you go to the intraday markets and you say, oh, it's down 50 cents, you may get freaked out like, well, this ain't going up, I'm not going to bother with this. Or there's a possibility that this thing has already moved 2 points of the 3-point expectations, which means 2/3 of your profit expectations has already happened and it's no longer a candidate based off today's price action. Okay, so that's the caveat that says we encourage you to do this when the close of market is there, so you don't have anything bothering you with intraday machinations and you don't have to worry about the day's move already evading part of that profitability. That being said, we are here with these intraday sessions. Let's look at this date as if we were close of market. And here's one thing that Tom and I know to do is if we're looking at contracts and position size, and we only want to risk no more than 500 on a trade, there are stocks in here like Ulta, Lululemon, Constellation Brands that are going to be so high priced that their options aren't going to be under 5 on a straight call option. So we start going to these stocks that we know that are lower than 100 points, like a Starbucks, okay? So if I click on a Starbucks, I can look at the price of Starbucks. Anybody have the current rate on Starbucks? I had $79.90 before we started talking here today. What do we have on Starbucks right now? About the same? Anybody typing it in there for us, Tom?
You looking for a stock price?
Yeah, I got 79.09. Okay,
Yeah,
so is that good enough for everybody? One more time.
79.10.
79.10 it is, okay?
It's up a penny from where you were.
That's right. We're on the right move. Thanks, Money Calendar. All right, so we have 79.10 current price, because remember, folks, what we're doing with Money Calendar is we're writing down on a separate piece of paper so that we can take the information from Money Calendar, apply it to our options analysis. So we write the ticker down, SBUX. We write the current price, or because you're doing it at the end of market, you're writing the closing price, so 79.10, and then we take into account the average profit move. And the average trade, the average profit move or average price move is $2.18, okay? And you can see the 10-year, each year calculated P&L when you hover your cursor over each of these bars. So write down 218 and then put the target price for that. So current 79.10, average profit 218, target 82.28. Am I wrong on that? Or is it 81.98? To 81. What are they typing in there, Tom?
Well, you know, you could just average it, Jay.
Yeah, let's just call it 82 then.
$5. Look at $5 off of 79.10, okay, and you're looking at 84.10.
Right, that's where I was going next. After we calculate the pure number, average trade 218, Tom's looking at the cumulative days overall. And in fact, I mean, you can look at these last 2 years, and that's an average of 4 points. So let's take it up to even 83, okay?
Yeah,
we're 83 and a half is a target there, okay? So there we go. We've established a target price. And what is our end date for this? You scroll back up here, and if you're not on the previous screen, it shows you right there, April 13th. So April 13th is the end date. What's the expiration just past that? We love it when it's the third Friday of the month, which it is, because that's where the tightest slippage is and the higher liquidity is. So that's an April 17th expiration. Y'all agree on that too? Okay, so now we have a game plan. We need to see if there is an opportunity with Starbucks making it up to 83 on or before April 13th. So let's go into the stock and options chains. I've done that. One thing that you can do is you can go to searchers, multi-strategies, and find trades. Type in the symbol, click change if it's not already there. We're going to leave it bullish, less than 45 days. And let's start with a buy call and click search. The thing is we want to look at now is this column that says click trade below for options analysis. Are we going to find an April 17th expiration in here? Doesn't mean that they don't exist. It just means with the limit that this screen will populate is an April 17th showing up before it doesn't show any more candidates. And that's not the case. You can scroll all the way down and there's nothing past April 9th. We're back to the old school way of options analysis. So let's go up to option chain. And we're at Starbucks. If not, change it, click update, and then select your option expiration that you want to analyze and research. April 17th, click update. And here it brings it in, April 17th, 45 days left, okay? Now, granted it's 45 days out, Money Calendar Max goes out to 30 days, and our end date is what? April 10th, I believe, or where was it, guys? It's right here, April 13th. So win, lose, or draw, you should be out of this by close of market April 13th, because we don't know what's going to happen from April 13th through the end date unless you do a different set of analysis for those specific days. But you're not building a trade around those later prospective days. You're doing it off of this period of days range from March 3rd to April 13th, okay? So where are we here? That's the spread option I wanted to take a look at. So here we are, April 17th, we have 79.53. Actually, we calculated at 79.10, okay? So one thing you can look at, folks, you can do it in your head, do it on a calculator, do it on a sheet of paper. Our target is 83, okay? So if we look at the stock price right now at 79, that's a 4-point move. The question is, as you look at these strikes over here and the cost of these options, if you were to entertain a 77.50 call and you can get that at $5, which is that mid price right there, what's a double? $5 doubled is 10 points. That means this stock needs to be 10 points in the money to this strike price to at least have $10 of premium sitting out there. Because a $10 premium that you can sell at 10 from a $5 cost, that's your double. But that means 10 points in the money if you have to wait till expiration and it just sits there and there's only real value left. You need to be at least 10 points in the money. That means the stock needs to be where? 87.50. What is our target price? 83.50. It doesn't show the capabilities to reach that high. So that's a situation where you can mentally and see in your head how us traders are looking at this and thinking about this when it comes to our potential return. Yeah, it's at 5. That meets the criteria of 5 or less. Okay, we got a 9 out of 10 stock, meaning 9 out of 10 years it's gone higher. Okay, but our realistic expectations for a double is not there because it needs to be 10 points in the money, and our target price based off the current price to our average price isn't there. So you can still entertain that, just know that you won't get a double. Maybe you'll get anywhere up to a double and say that's fine. Or let's see if there's a spread opportunity out there that can fit the bill. And so what we did here is we took, and I have the risk graph for it here on the other tab, but I'll show you what we did. Okay, so if we're going to entertain a spread now, okay, our target 83 and change, we need the stock to be above one of these strike prices. So if 83 is the target, what's the strike just underneath it? How about an 82.5? Let's start there. We can look there. You can play around with these all day long before you make your final decision. But this is the starting point. Find your target price, take the strike just underneath that, and then start looking at how wide a spread you want to do, what you can get, what the returns are for them. So here's 82.5. We're going to, again, on a bull call spread, call debit spread. We're going to buy the lower, sell the higher. So we're going to sell that 82.50 by doing a -1 because a minus and a number is selling, and just a straight number is, or the positive number is buying. So let's start with a $2.50 wide spread. Okay, buying the 80, selling the 82.50. Click risk graph, and I've done that, but I'll go to the more updated one here. We're looking at $118 debit, $118 cost per contract. Okay, what's the potential max profitability on a rate of return basis? 112. How do we figure that? Again, when is max profit realized? At expiration, so long as the stock or the security is above the sold strike. It needs to be above 82.50. On a call debit spread, unlike the put credit spread, we need these option legs to exercise. We need the universe to call away the stock at 82.50. Now, if the stock's above 82.50, that's entertaining to feel folks because it's cheaper. I can buy it less from the person at 82.50 than the open markets. So that option gets exercised. Check with your brokers on how same-day substitution and all the like works in your accounts, because you want them to then exercise, or they should have it set up so that it does auto exercise, that when the 82.50 gets called, they exercise the 80s and you pocket the $2.50. Remember, you sold this. They can buy the stock from you at 82.50. You buy from the markets at 80, and you have a $2.50 profit sitting there, offset by the cost to even go after that chance. So the max you can make is 250 offset by the 118 cost, leaving you with what? $132 max profit potential. Okay. And 132 based off of 118 cost is your 112%. Do y'all see that? Do you all like this capability? Do you check the charts and see, can it get above 82.5? Well, here's all this consolidation right in here between 80 and 85. I would say 82.5 has been hit multiple times. It's been much higher than that. And could we recover off of this downdraft here? Maintain these levels. And again, the max risk is 118, okay? If you want a position size, you would do how many contracts? Probably 3 contracts. So type in your number, 3 and then 3, and click update or risk graph again. And there we go. Can we get another 118 in there? Can we go a 4th contract? Let's do it and see. The worst that happens is you have to go back and change that to 3 and 3 again. But there you go. You can go after 4 contracts and still not break your $500 max risk per trade threshold. So there you go, folks. Tom, there's the opportunity. I mean, if you like the call option opportunity, there's not a chance at 100% are there based off what we were looking at. But if we looked at the spreads on this situation here we found an opportunity for 111%er. You guys just have to believe in Starbucks higher and Starbucks higher than 82.50 at expiration. If that's the case, you go to your money calendar buy folder, left click on that and save it in there. And then if you guys want to, mess around with wider spreads, a $5 spread or whatever the case may be, have at it. You now know how to do that. You've seen the navigation process. Just go in there and play around with the tool some more.
Yeah, and just a couple comments that I'll throw up there real quick. One person had said, why are you looking at Starbucks with coronavirus not in the U.S.? That if it comes to, this gets bigger, people are going to stop shopping there. And my comment back was, it's a good point, but drive-throughs are going to become the norm for anybody that's that has to be on the road, going back and forth from wherever. You at least eliminate some of the problem that way. I think that might be an alleviation. But at the end of the day, we're not trading on news so much. We're trading on rules-based strategies. And you know how we get around this? We find just as many bearish opportunities as we do bullish, and try to look for the spread between profitable ones and ones that aren't profitable. That's the way we do it. Martine was asking how 83 is a target, and
she did right,
Martine. If you really want to dial it down to dollars and cents, 81.28, 81.74. But what I like to do, and I'm sure Jay's kind of the same way, is we have this kind of what have you done for me lately question that we ask by looking at the yearly patterns. And if the yearly pattern is a positive pattern, what have you done for me lately shows that it was over $5 last year. It was about $3 the year before. So we factor some of that in when we look at it, and you look at the volatility of what it's doing today. And the volatility of what it's doing today is it's a lot more volatile today than it was in prior years. So, if that move actually happens, if it does, come in and happen, that it might happen faster, more quicker, and you could see a big move. I mean, let me just show you, Jay, if you're done, I'll grab the.
Oh, by all means, yeah. Unless you want me to show anything, I brought up the chart to show them what you were saying. The more recent bars there are getting higher, and that's what Power Meter's showing you too. Is the more recent years profitability is greater than the cumulative 10 overall. Okay, so by all means, Tom, take it back.
You what, if you want to look at volatility, look what's happened just in the last, half hour. I'm actually going to change this to just the 2 charts here, so you can see this is the S&P. This is the bond market, and this is the S&P from the time it first dropped below the first hour low, and it moved above it, and it moved below, and it's just now all of a sudden we're getting these people just bar the door because everybody's cramming through at the same time, and it came right back. And look at the bond market. We went from 155.24, that was the high at the first hour of the day, and it shot up and went parabolic, and we went from 157. 10 minutes later, it was at 159.5. Now we're back down below 158. I'm short this. I mean, I got short this around the 156 half area, and so yes, I'm behind on this one. I did an option trade. In fact, where's my option trade at? I got it right here. Here we are. This is what I did. So this first order, which says TLT, I canceled that and I made it a 20 lot. So I have OIH. I'm in at a credit of 23. It's 24 by 27. So I'm down 2 or 3 cents on this trade right now. I got filling those 97 options. And then this one's 43 by 59, and I'm at a credit of 45. So I'm a little bit south on that based on that bid and ask. But then, you know, looking at what's happened, it was a lot worse a few minutes ago, and it's getting a little bit better now as this is coming down. I just think that all of a sudden now people are throwing market orders at the stock market, and they're throwing market orders at the bond market. And that's why you saw that big run up and then crush, and then the big run down, and now the buyers are coming in, and we'll see where it ends out today. But that's volatility, and there were questions that were asked about, you know, why aren't you trading Tesla? How come that's not in the penny pilot? You know, how come Tesla and a couple of others were not in there? And the answer is that, you know, let's just look at Tesla real quick. TSLA, and this might not be representative of the whole thing, but I mean, you know, a week ago it was at 856, went down to 611, came back to 806 this morning, down to 724. You know, this one's down 18 points today, but look where it was in the morning. I mean, it was up so high and it just fell apart in the end. And the thing is that this is going to equate into volatility. So let's just take a look at the 725 calls. All right, so TSLA, all right, 20 is the year, 03 is the month. Let's look at 06. Let's just look at the options that expire on Friday. C, 725s. Look at this. $86 in the morning, $28 in the afternoon, and more importantly, 27.80 by 28.45. That's probably a good bid ask on Tesla compared to where it was this morning, right? With these big stocks, you're going to get a better bid ask spread in the afternoon than you would in the first few minutes of the morning, especially when you get a jump up like it did this morning. So that's Tesla. Another one was BKNG. Booking.com. All right, 1654. This was down $74 today. Now look at the booking. All right, .bkng. Okay, then we put in 20 for the year, 03 for the month, 06 for the day. Let's just put a call option in there, and let's look at the 1650s. Wow. I mean, there's no movement. This is terrible. 47.50 by 53.90 is the bid and offer. The bid and the offer is $6 apart, over $6 wide. So this is a really good example of you know, why we're not looking at some of the really big expensive stocks right now, because their bids and offers are just so gigantic. All right, guys. So that is, you know, really what we wanted to talk about today. We want to talk a little bit about calls. We wanted to talk about, you know, calls and puts, for instance. We did get into why we're trading spreads today, because calls and puts in most cases are expensive. They're very expensive. And so, you know, we're trying to look in a different direction, where efficiency, where bid-ask spreads are a little bit tighter, and so, you know, could go on and on and on. Yeah, so that's what I'm looking at. And guys, again, you know, for those of you that are looking at, you know, at what I've got here on my trade, I mean, the trade that I did for OIH, if I open that up, that's the 320 options, the ones that expire on the 20th. All right. As far as the TLT, that's this week. That's a 3.6 option. All right. So 6 is the first week of March. Then you've got 13. 313 is the second week, and 320 is the third week of March, and that's That's pretty much what I did. We'll follow along and see how these end up going. But you know, and let me say this: I'm giving you guys, you know, showing you kind of what I'm doing. I will show you what I'm doing when it comes to ETFs, because ETFs are not going to move the market one way or another. You know, there's a lot bigger players out there than me. I will not jump in a stock ahead of showing you, because I don't want to be accused of front running a stock. It's not what I'm here to do. I'm here to teach you how it is that I am spotting trading opportunities. All right, that's what I'm doing. All right, guys, as we end out another session, another live trade session, I might want to remind you, this is, you know, we're not trading on hopium. We're not trading on fear. We're not trading on greed. We spot the rules-based opportunity for stocks and ETFs, right? Creating that low-risk trade, well, that's going to be a little different for each of us, but we use options to do this. And right now, spreads, because spreads, and I'm doing a lot of spreads that are as close to 1-to-1 as possible. Okay, so you know, when I showed you the trade in OIH and showed you trade on TLT, those are very close to 1-to-1 reward to risk ratios, because volatility is so high. I don't want to put something out there that has a low volatility, that has a 10-to-1 reward to risk. All right. At the same time, I don't want to take a high probability trade where if I'm right, I make $1, and if I'm wrong, I lose 9. Don't want to do that either. I'm looking, the higher volatility goes, I'm just looking at 1-to-1s based on my rules-based opportunities. And it's just a matter of planning, executing, and managing, which I've done the plan, I've executed. Now I've got to manage these trades. One I need to manage by Friday. The other one, I've got a couple of weeks on. All right. And typically with ETFs, I look for a 50% return, as I showed you with the SPY trade that all of us looked at that were here last week as it came through. So I want to thank you for joining us today. Tomorrow we'll be back. We'll talk a little bit more in depth on debit and credit spreads tomorrow and the difference between one versus the other. And of course, we'll be back talking more about money patterns. I'm going to go back into looking at something called the money clock. And I want to show you guys the money clock, the short-term pattern that we'll look at as well. So thanks for joining. Video will be out to you soon. And we'll see you tomorrow, same time, same channel. All right, guys, have a great day. And we'll talk to you tomorrow. Bye now.